All right, let's dive right into this explainer of IND AS 113. We're going to take what usually feels like a totally dense accounting standard and translate it into a logical, step-by-step playbook for pricing assets and liabilities. If you've ever stared at a balance sheet and wondered how in the world companies actually arrive at the numbers sitting next to their most complex assets, well, you are in exactly the right place. We are going to break the whole thing down.
Before we even touch the heavy rules or the technical jargon, I want you to ask yourself a super practical question. How much is your asset really worth right now? I mean, how do you actually price something that doesn't have a neat, clear price tag attached to it? It sounds like a simple concept, but in the world of corporate finance, answering that question requires a really rigorous framework.
Think of this explainer like a detective's funnel. Today, we're going to cover defining fair value, finding the right market, valuing different asset types, the valuation techniques themselves, and finally, the fair value hierarchy.
Okay, starting us off with Section 1, defining fair value. And trust me, this is a massive paradigm shift. So you have the textbook definition straight from the standard right there. But honestly, I want you to focus on just a few keywords: price received to sell and paid to transfer. The absolute crucial point here is that fair value is not an entry price. It's not what you originally paid to buy the thing. It is strictly an exit price. It's exactly what you would get if you walked away and sold it today, in an orderly transaction. Meaning, absolutely no distress sales or forced liquidations.
Now, when you're calculating that exit price, you've got to look at the specific characteristics of the asset or liability itself. Things like its physical condition, exactly where it's located, and any restrictions on selling or using it. But, and this is a massive caveat, you absolutely must ignore entity-specific restrictions. Fair value is a market-based measurement, right? Not an entity-specific one. If restriction only applies to your specific company but wouldn't apply to some other market participant buying the asset off you, you just don't factor it into the fair value.
Moving right along to Section 2, finding the right market, or exactly where to look for these prices.
IND AS 113 actually gives us a really clear rule of thumb for this. You always default to the principal market if there is one. Why? Well, because the market with the highest volume and activity is naturally the most liquid, so it's going to give you the most reliable price. But if a principal market isn't obvious or it just doesn't exist, you kind of have to become a bargain hunter. You hunt for the most advantageous market. This is the market that either maximizes the amount you'd receive for selling an asset or minimizes what you'd have to pay to transfer a liability.
And this breakdown brilliantly illustrates the math behind finding that most advantageous market. Just take a look at these three options. To find the winner, we look all the way down at the total row, which deducts both the transportation and the selling costs. Market A clearly maximizes that net amount at $470, beating out B and C. So Market A is our target market. But wait, look closely at that final row. The actual fair value recorded for Market A is $480, not $470. So why the difference?
Which brings us to a really vital distinction. Did you notice in that calculation we just did? Fair value adjusted for transportation, dropping that $500 down to $480, but it completely ignored the selling cost of $10. There's a very specific reason for that. Selling or transaction costs are just a cost of doing business. They're a characteristic of the transaction itself, not a reflection of the asset's inherent worth. Transportation costs, on the other hand, are a characteristic of the asset because they relate to the asset's physical location. You have to actually get it to the market to sell it, right?
All right, on to Section 3, valuing different asset types, specifically physical versus financial. So for tangible, non-financial items, we're talking office buildings, heavy machinery, intangibles, biological assets. We can't just look at how a company happens to be using them right now. We actually have to look at their absolute maximum potential out there in the open market.
To find that true maximum potential, you've got to run these non-financial assets through a three-step highest and best use checklist. First up, is it physically possible? Think about the size and location. Second, is it legally permissible? Like, what do the local zoning laws say? And third, is it actually financially feasible to generate an adequate return? You must value the asset based on this absolute highest and best use, totally regardless of how your specific company plans to use it. Seriously, if you want a factory sitting on prime commercial real estate, market participants might value it way higher as a retail mall. You have to value it as a mall, even if you just keep running it as a factory.
But hey, here is a super quick, absolutely critical rule to remember. If you're dealing with financial assets, things like shares, derivatives, or bonds, you skip that highest and best use test entirely. Financial assets don't have alternative physical uses, so applying that whole concept just doesn't make any sense.
That naturally leads us to Section 4, the valuation techniques. These are your tools to actually extract that value.
The standard essentially hands you three distinct approaches to pick from. You've got the market approach, which simply looks at prices generated by market transactions for identical or comparable assets. Then there's the income approach, which looks inward to the asset's earning power, calculating the present value of all its future cash flows. And finally, the cost approach. A lot of people call this the replacement cost approach. It basically asks, how much would it actually cost to replace this exact asset and get it to a working condition today? Your job is to choose the technique that maximizes the use of relevant, observable market inputs.
And finally, Section 5, the fair value hierarchy. This is all about grading your evidence. This is where IND AS 113 really forces your hand. It makes you prioritize direct, observable market data over, well, educated guesses. It ranks everything into three strict levels. Level 1 is the absolute gold standard, quoted unadjusted prices in active markets for identical assets. Think of stocks trading heavily on a major exchange. Level 2 involves inputs that are still observable out there, like interest rates or yield curves, but they aren't direct quotes for identical assets. And then there's Level 3, the lowest priority, unobservable inputs. This is stuff like a company's internal financial forecasts, and you only use this when real market data simply doesn't exist. The rule of the game: maximize Level 1, minimize Level 3.
But, the rules aren't totally rigid when reality itself shifts. Imagine a publicly traded biotech company. Let's say their stock closes at 36 rupees, but right after the market closes, news breaks that their major clinical trial totally failed. Boom. The next morning, the stock opens at 22.50. The standard says that if a significant event happens after the market closes, that pristine Level 1 quoted price of 36 no longer represents fair value. You have to adjust the quoted price to incorporate this new reality. But here is the catch. The second you adjust a Level 1 input, it automatically drops down and gets reclassified as a Level 2 measurement.
Okay, let's pull all of this together. This flowchart does a really beautiful job summarizing the entire decision tree. It starts right at the top, asking a simple question. Is a quoted price in an active market available? If yes, and no adjustments are needed, you've got yourself a solid Level 1 input. But as you flow down the chart, the moment you have to start making adjustments or rely on significant unobservable inputs, you are funneled directly into Level 2 or Level 3 territory. It's just an incredibly logical system designed to ensure that balance sheets reflect as much objective reality as humanly possible.
As we wrap up this explainer on IND AS 113, I want to leave you with one final, pretty important thought. I want you to use this hierarchy to rigorously question your own balance sheet, or really any balance sheet you analyze. If you had to liquidate tomorrow, are you relying on cold, hard market reality, or are hidden Level 3 assumptions artificially inflating your exit price? Because understanding fair value isn't just about ticking boxes for accounting compliance. It's about seeing the true underlying economic reality of an asset. Thanks for learning with me today, and hey, keep questioning those numbers.